Hey guys, today we'll be talking about the IAS 21 foreign currency transactions. But before we start, I think it's important that we define some of our terms. The first term I'm going to be defining for you guys is translation. Translation is the process of expressing monetary amounts that are stated in forms of foreign currency by a direct exchange rate. The next term I'm going to be defining for you guys is exchange rate. The exchange rate is the ratio between a unit of one currency and the amount of the other currency for which that unit can be exchanged for at a particular point in time. Now, another question for you guys is what determines the exchange rate? The relationship is largely actually determined by supply and demand factors, and these supply and demand factors are called floating rates. Floating rates increase the risk to doing business with a foreign company because after the rate changes, all transactions are conducted at the new rate until the next rate change occurs. When talking about foreign currency transactions, there's actually only three currencies we need to keep in mind. First is local currency, second is functional currency, and third is the reporting currency. Now, I'm going to briefly be talking about local currency and reporting currency here, and I'll go into more depth about functional currency later. First, local currency is any type of transaction your company may have. So whether it's a subsidiary located in another country or it's just kind of your main operations here in the US, it doesn't really matter kind of which currency you'll be using because you're going to be translating that currency into what your functional currency is. Now, your reporting currency is whatever currency that you're going to be writing on your financial statements at the end of the year. And this reporting currency is usually based off of whatever your functional currency is, or also it could be based off of what country your company is located in. So now we're going to be talking about functional currency. Functional currency is the currency of the primary economic environment in which the entity operates. This is where the entity generates and expends most of its cash on a day-to-day basis. So the three considerations to take into account are the currency that dominates the determination of the sales prices, the currency that most influences operating costs, and the currency in which most of the entity's finances are reported in. Now we're going to be looking at the three requirements for recording the transactions in the functional currency. Now we talked about earlier how the exchange rates are constantly changing every day. So that's why it sets up the first rule, which is recording the transactions at the current exchange rate in place on the date that the transaction occurs. For the second one, its monetary assets and liabilities are retranslated using the closing rate at the reporting date, with any gains or losses going through profit or loss. The third one is non-monetary assets and liabilities are not retranslated at the reporting date unless carried at fair value, whereby you'd have to translate it at the rate where fair value was established. Now, for the second and third one, you have this monetary and non-monetary concept, and it's just important to keep in mind what monetary assets are, and that is your cash, receivables, payables, bonds, things of that nature, things that are readily convertible to cash. Whereas you have the non-monetary assets, which are land, building, equipment, things that you can't really convert to cash quickly. So the difference between these two things are the monetary assets can be recognized as profit or loss through all the gains or losses you have through translation. Whereas the non-monetary assets, you don't have to necessarily show this profit or loss on your financial statements at the end of the year, unless they are carried at fair value, which then it's a little bit different. So now let's see how this works in an actual problem. Jones Inc. has its functional currency as the US dollar. It trades with several suppliers overseas and bought goods costing 400,000 dinar on December 1st, 20x5. Jones paid for the goods on January 10th, 20x6. Jones' year end is December 31st. The exchange rates were as follows. Show how the transactions would be recorded in the financial statements. So here's our first journal entry for the problem. What we just did is we bought goods on credit for 400,000 dinar. We know it's on credit because we're not actually paying for the goods until January 10th. Now, the reason we know it's 97,561 is because on the date of the transaction, which was December 1st, the current exchange rate was 4.1 dinar to US dollars. So we just have the simple calculation of using the 400,000 divided by the 4.1, which gives us an accurate number in US dollars. So the next step of the problem is looking at the year-end December 31st and how that relates to our monetary and non-monetary assets and liabilities. So for our non-monetary assets, we have inventory. Remember, non-monetary is things that are not readily convertible to cash. So we have our 97,561. That's just going to stay the same. It's not going to change at all. But however, for a monetary liability, which is accounts payable, so when we had that original transaction of 400,000 dinar, we used the exchange rate of 4.1. Now we're using the exchange rate 4.3 because that is the exchange rate that coincides with December 31st. 4.1 was the exchange rate for December 1st. So because of this, we're actually going to have a different number now that's going to be $4,538 less than what we would have originally had of the 97,561. The reason that we have to make this adjustment is make sure we accurately portray the profit or loss that we have from changing exchange rates. So just the last piece of the problem here is we have our journal entry for accounts payable, $4,538, and the transaction gain of $4,538. Now we just have to make this before we release our financial statement because it is a gain, and if we don't recognize this income, then it would be fraud. So that's all the problem asks for, but also something to keep in mind is if we were going to make this journal entry for when we actually pay off our accounts payable on January 10th, we would have to remember to use this different exchange rate of 4.4, which would once again then alter the exact amount of profit that we were going to be making. I hope you guys have learned a lot about foreign currency transactions, and I hope you guys all have a great day.